Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be making sense of the financial sector. In last week's third quarter review, we mentioned that financial sector stocks are showing signs of life and actually beginning to outperform. In the era of easy money, cloud computing, and AI, the financial sector has taken a back seat for a lot of investors. Banks, insurers, and other financial service providers are also very different from most companies, and they can be tricky to understand and analyze. With that in mind, we decided to do a two-part primer on financial sector companies and how they make money. This week we'll cover banks and companies in the capital markets industry, but next week we'll look at insurance, diversified financials, payments, and fintech. Before we dive into what happened in markets this week though, here's our quote of the week from Warren Buffett. In the end, banking is a very good business unless you do dumb things. You get your money extraordinarily cheap and you don't have to do dumb things. But periodically, banks do it, and they do it as a flock, like international loans in the 80s. You don't have to be a rocket scientist when your raw material cost is less than 1.5%. Now, let's dive into what happened in markets this week. Here's a quick summary of what's been going on. First up from CNBC. OpenAI closes funding at $157 billion valuation as Microsoft, Nvidia, and SoftBank join. What's our take on this news? $157 billion is a hell of a lot for a non-profit. To be fair, OpenAI is reported to be considering restructuring as a for-profit business, which makes sense with that sort of valuation. The valuation itself is also interesting. The company raised $6.6 billion at a price that represented a post-money valuation of $157 billion. That implies that it will earn a fortune from its model, while also competing with several open-source competitors. For Nvidia and Microsoft, the cash they have put in could be viewed as more of a business expense than an investment. By investing in OpenAI, they are developing the market for their chips and cloud services. They don't necessarily need to make a profit on the investment itself. In the end, we will have to wait and see how the other investors do on their investments. Next up from the Financial Times. India tightens derivatives trading rules after retail options frenzy. What's our take on this news? Reining in derivative trading can suck liquidity out of a market very quickly. Derivatives like futures and options have several functions, but for many, the attraction is leverage and the opportunity to increase gains. For brokers and exchanges, leverage translates into higher volumes and more fees, and banks are quite happy to earn interest by financing derivative trades. The problem is, when stock prices inevitably correct, the owners of derivative securities become forced sellers. If your margin on a futures contract is 10% and the price of the underlying asset falls 10%, you need to sell the contract or cough up more margin. Forced sellers drive prices lower, which creates more forced sellers. Regulators get nervous when they see speculative derivative trading increasing. They can curb that activity in several ways, including increasing the margin requirements. But doing so can also trigger a wave of forced selling, and it has on several occasions. For patient investors, this can create great opportunities once the dust settles, so keep your eyes peeled and your cash ready. Next up from Bloomberg and the Economic Times. Moody's upgrades Brazil's credit rating while Fitch warns of trouble ahead. What's our take on this news? Government reforms and robust economic growth were enough to convince Moody's to upgrade, but Fitch has its concerns. Brazil's government bonds are now on par with Oman and Morocco in terms of their creditworthiness, but it's still shy of its investment-grade rating it lost almost a decade ago. The country's central bank now expects GDP to grow at 3.2% rather than the 2.3% it expected in June this year. But some investors and rating agencies, like Fitch, are concerned about the government spending and impact on its fiscal accounts. While the agency acknowledged improved economic performance, it anticipates challenges for the country in 2025 and higher country debt levels. While the expanding economic performance was occurring at the same time as increased leverage from the government, it was cautious about what would occur during an economic downturn, which is typically when governments expand their debt levels to provide support to the economy. While the economy seems to be on the mend thanks to heavy government intervention, the country's bonds haven't reached investment grade just yet, and the reasons to be cautious mentioned above could mean it stays that way. Next up from S&P Global. Video game profitability ticks down in first half of 2024 despite headcount reductions. What's our take on this news? The video game industry may be due for another round of belt tightening, or margins may be about to expand. Despite many companies in the industry conducting layoffs and studio closures over the last 12 months, their profitability has still reduced. Total revenue for the 100 companies in this bracket declined 6.3% year on year to June 30th, 2024. Meanwhile, EBITDA, or earnings before interest, tax, depreciation, and amortization, fell 10.2%. Some names you might recognize in this list include Sony, NetEase, Electronic Arts, Nintendo, Take-Two Interactive, Roblox, CD Projekt SA, and Microsoft's gaming division. Layoffs can take time to flow through to the bottom line due to severance packages and separation agreements taking months, so the relatively small decline in margins could actually be seen as a win for now, considering the past 12 months was pretty light on software releases and had a few high-profile misfires. Watch these companies over the next 12 months to see if the layoffs finish and profitability climbs. Next up from VentureBeat, NVIDIA launches a new open-source LLM to rival GPT-4. What's our take on this news? NVIDIA isn't just acquiring new customers, it's competing with them too. NVIDIA has just launched NVLM 1.0, which is a family of large language models, LLMs, that is looking to take the fight to some of the heaviest hitters on the market. NVIDIA claims to be heading down the open source route, offering the training weights and training code to the public, which is a nice win for researchers and developers. Like other open source LLMs, the model is not truly open source, with no information on the training data made publicly available, but it's a step in the right direction. The model seems to match up quite well with other LLMs like Llama 3, GPT-4, Gemini 1.5, and Claude in certain benchmarks, and interestingly, it seems to perform better at text-only tasks after multimodal training, something which other models fail to do. This is a really interesting business move for NVIDIA, as they are undoubtedly hoping to create a positive feedback loop. Consumers will buy NVIDIA hardware to use the model, and with more people using this open model, there will be more contributors who are making improvements to it, which could see performance and demand both climb. And lastly, from Reuters, dock workers and operators reach a tentative deal, ending the East Coast strike. What's our take on this news? The power of the International Longshoremen Association was on full display as workers secured a handy pay rise. The deal reached between the ILA and the United States Maritime Alliance brought an end to the 3-day strike that saw 45,000 dock workers strike on the US East Coast and Gulf Coast. The strike was the first major work stoppage for the ILA since 1977, which arose as negotiations over a new work deal broke down. While the ILA was seeking a 77% pay rise, after negotiations, a tentative agreement was reached for a wage hike of around 62% over 6 years, increasing average wages from $39 per hour to $62 per hour. The deal ends the strike, which prevented the unloading of container ships from Maine to Texas and threatened shortages of almost all goods coming into the US, which triggered a backlog of anchored ships outside major ports. The strike shows just how strong the ILA is, as the US's reliance on ports means that a longer-lasting strike could cripple industries that rely on goods or materials imported from overseas. Now, let's dive into the main piece. What makes financial sector stocks tick? If you look at the sector composition of most stock markets, the financial sector accounts for between 20% and 35% of the total value of listed companies. It's lower for the US market at 13%, but that's due to the dominance of technology companies. Needless to say, financials play a crucial role in developed and developing economies. Historically, banks, insurers, and other financial service providers have proved to be compounding machines over long periods of time. That hasn't generally been the case over the last decade, and there are two reasons for this. Firstly, near-zero interest rates aren't ideal for banks, but they are great for growth companies, and that's what investors have been focusing on. And secondly, many of the largest financial institutions have been repairing the damage caused by the GFC of 2008. If the easy money era is a thing of the past and interest rate cycles look more like they did in prior to 2008, financials might be worth more attention. But financials like banks and insurers in particular are very different from most other companies. As a hot tip, financial companies can be tricky to classify as they often operate several different businesses. This means that competing financial companies are often categorized in different industries. If you're using the stock screener, it's worth casting a wide net. To include all financial sector companies, make sure you add the following categories to your search: banks, insurers, and diversified financials. Alternatively, if you're looking at a specific company, you can find their competitors and peers on the company report, within the company overview, and within section 1.3 and 1.5 under the valuation tab. So, speaking of the financial sector, let's start with banks. Banks are at the heart of the financial system and the financial sector. They provide the financing that allows consumers to buy houses and vehicles, and for most businesses, they are the primary source of finance. The core business of a bank is to make loans and hold deposits. The banks make money by charging a higher interest rate on the money it lends out than what it pays on deposits. Just a quick reminder, from a bank's point of view, a loan made to a borrower is an asset, while deposits held on behalf of a customer are a liability. When it comes to the business of borrowing and lending, standard metrics like revenue and net income don't really tell the whole story. The following items are the most important metrics and ratios for a bank. Firstly, there's the net interest margin. The net interest margin is the difference between the weighted average interest rate a bank receives and pays. This determines a bank's net interest income, which is its primary banking income. Then there's the asset to equity ratio. This ratio tells us how big a bank's loan book is compared to its equity value, which is basically assets minus liabilities. The higher the ratio, the more risk the bank is taking. Then there's the efficiency ratio. A bank's efficiency ratio reflects its operating expenses as a percentage of revenue, which includes net interest income and other revenue. This tells us how much it costs to run the bank compared to the revenue it earns, and is a good way to compare the efficiency of competing banks. The next ratio is the loans to deposits ratio. This LDR reflects a bank's liquidity by comparing loans to deposits. It indicates how easily a bank can cover loan losses or withdrawals. Then the next metric is non-performing loans. Non-performing loans are the percentage of a bank's loans that are delinquent or have been written off. This number reflects the credit quality of a bank's loans. The next metric is allowance for bad loans. Banks set aside capital to cover the loans they expect to write off. This number needs to increase when economic conditions worsen. Then there's the price to tangible book value metric. A bank's tangible book value is the value of its equity minus intangible assets like goodwill and trademarks. This is a common valuation ratio for banks and compares the share price to the equity value per share. And lastly, there's return on equity and return on assets. Profitability ratios like return on equity and return on assets are a useful way to see how efficiently a bank is using its resources and to compare it to other banks. For large banks, you can find some of the key ratios and data points on the company report under Section 4 in Financial Health. Now that we've covered banks and all of their important metrics, let's move on to investment banks. Most of the biggest and well-known banks have investment banking divisions. Investment banks earn revenue in several ways. Firstly, there's fee income for advising on and underwriting IPOs, corporate bond issues, mergers, and acquisitions. Secondly, there's profits generated from sales and trading of securities. And lastly, there's commission on trades executed on behalf of institutions. Investment banking can be very lucrative, but it's also dependent on market conditions. Profits can be sporadic, and trading desks can suffer from occasional large losses. The next type of business in the financial sector is capital markets. Some of the best performing financial companies of the last 20 years have been those that facilitate financial market activity in various ways. That shouldn't really be surprising, as the value of financial assets and trading volumes have grown exponentially, as you can see from this chart. Next up, there's asset management businesses. The asset management industry includes companies that manage assets on behalf of pension funds, other institutions, individuals, and on behalf of their own shareholders. They manage ETFs, mutual funds, private equity, and venture capital funds. The first distinction to make is between asset managers that earn fees managing money on behalf of customers and those that invest shareholder funds directly. BlackRock, the largest asset manager in the world, earns fee income managing ETFs and other funds for clients. This means it doesn't put its own capital at risk. Then there's KKR, which is one of the largest private equity and real estate companies in the world. KKR does manage funds for clients, but it also invests directly in other companies and real estate. Asset managers that invest on behalf of clients typically earn a fee which is a percentage of the assets under management, known as AUM. Their fees go up when they attract new funds and when the value of those funds increase as stock prices rise. Then, the next type of business in the financial sector is brokers. Online trading platforms have made investing accessible to millions of people around the world. Technology has also meant stockbrokers can service more customers without increasing headcount. Paradoxically, while trading fees have fallen, the increase in volumes have resulted in increased revenues. Most brokers also offer asset management services, and there's a good reason for this. Trading activity is closely correlated with the direction of the stock market, which means trading commissions drop off during bear markets. Asset management generates ongoing management fees, which are less sensitive to market activity. This means brokers with a large wealth management business, like Charles Schwab, have more predictable revenue streams than those like Robinhood, which is more reliant on trading commissions. And lastly, there's financial exchanges and data providers. Stock exchanges have themselves become some of the most successful companies on the stock market. As an example, the London Stock Exchange Group is now the 11th most valuable company listed on itself, the London Stock Exchange. Other exchanges include Hong Kong Exchanges and Clearing, Deutsche Börse, and Nasdaq. Exchanges benefit from the number of companies that become publicly listed and increasing trading volumes. Barriers to entry are also very high, which helps exchanges protect their margins. Companies that collect, manage, and disseminate financial markets data also have very distinct competitive advantages. The benchmark indexes that we all use to track the market are owned by a handful of companies like MSCI and S&P Global. These companies, along with Moody's and Fitch ratings, also provide research and credit ratings. The revenue generated by providing data, benchmark indexes, and ratings is more reliable than most other companies in the capital markets industry, but ultimately it is still correlated to growth in investment activity. So, what's the insight here? There's a big difference between recurring and non-recurring revenue. Banks and other financial sector companies generate revenue in various ways. Some of this is like annuity revenue that trickles in year after year. There will be fluctuations as a business wins or loses customers, but recurring revenue is reasonably predictable. Examples of recurring revenue include 1. Interest and principal payments on mortgages, auto loans, and credit card accounts, 2. Fund management fees, and 3. Subscriptions for data and research. Other sources of revenue are less reliable but can contribute significantly to the bottom line. Some examples here include, firstly, mark-to-market gains or losses on securities, secondly, profits generated from the sale of a stake in a private company, third, underwriting fees on IPOs, mergers and acquisitions, and lastly, trading profits. Some sources of revenue, like trading commissions, fall somewhere between the two. When assessing a potential investment, one of the first things to do is work out how much of a company's revenue and net income is recurring. This is true for all companies, but particularly for financial companies. Sometimes a share may look cheap when compared to recent earnings, but those earnings may be inflated by non-recurring revenue. Thankfully, Section 3.2 of the company report under past performance will help with this check. Keep an eye out for next week's newsletter, which will go over part 2 of the financial sector. Now, let's wrap up with the key events during next week. On Tuesday, we've got the Reserve Bank of Australia releasing the minutes from the last monetary policy meeting. We've also got Australia's NAB Business Confidence Index being released, and it is expected to swing from -4 to +2. On Wednesday, the US Fed will publish the minutes from the recent FOMC meeting. On Thursday, US initial jobless claims are due. Economists are forecasting 330,000 up from 225,000. Also, the US inflation rate is projected to be 2.3%, down from 2.5%. Prices are expected to be just 0.1% higher over the last month. The core inflation rate is expected to be marginally lower. And on Friday, UK GDP data will be published. The UK economy is expected to have grown 0.1% in August, which is an improvement on June and July's 0%. Also, Canada's unemployment rate for September is due and is expected to remain at 6.6%. Lastly, US PPI is forecast to be 0.1% higher month on month and just 1.3% higher over 12 months. This monthly increase is lower than the 0.2% increase last month. Now to wrap it all up, third quarter earnings season starts this week. The first of the big banks are due to report on Friday, with a few other companies reporting earlier in the week. Some of the names include PepsiCo, Infosys Limited, Delta Airlines, Domino's Pizza, JP Morgan Chase, Wells Fargo, Progressive Corporation, and BlackRock. And that's all for this week's Market Insights. Thank you so much for listening. And until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.